on your computer, on your smartphone, on your Wi-Fi radio. We're localwebradio.fm.
Welcome to Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, and recognized by Vancouver Magazine in its selection of top wealth makers in Vancouver for 2013. And now, here's your host.
Well, yes, this is your host, Eric Reynolds, and I'm here with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy. And today we'll be talking with Byron about how investor behavior is a critical part of increasing investment returns. Now, before Byron joins us, just a reminder that if you have questions or require assistance, you can reach Byron at 604-535-3700. That's 604-535-3700. Now, hi, Byron. It's great to talk to you today.
Hi, Eric. Yes, I'm happy to be here.
Now, Byron, since this is our first show, why don't you start off by telling us about your practice and what kind of experience you provide for your clients?
Okay. Basically, my practice is based on helping a finite number of successful households or families build their wealth, safeguard their investments, and preserve capital, and eventually pass those assets off to the next generation in a tax-efficient manner. Probably one of the easiest ways you can think of what I do is as being a family or client CEO. I would quarterback the decisions, the investment decisions, tax planning, estate planning, and also coordinate and organize the other professionals like accountants and estate planning lawyers. So in our business, some advisors are brokers where they trade a lot of stocks. I'm more of an asset manager where we will determine what are the most appropriate, investment classes for people to be involved in, and then I will select the appropriate managers for the individuals. So for over 30 years, I've managed this planning process by integrating a behavioral economic investment strategy and a demographic investment strategy as part of an intellectual foundation. And that's for me to base my advice on. And this helps me forecast and manage change. And it also provides a basis for what I call a forward-looking investment strategy.
Oh. Now, speaking of strategy, you mentioned a behavioral investment strategy and a demographic investment strategy. Could you explain those further, starting with the behavioral investment strategy?
Absolutely. The behavioral strategy is based on human nature. And believe me, that's a very strong influence indeed. And because of human nature, real people do not get investment returns. I say this at my seminars all the time. Real people do not get investment returns. They get investor returns. And there's a substantial difference, and the investor returns are substantially lower. So to give you an example of how that works, there's a group, it's actually two groups out of the United States, Lipper Delbar, and these people, they do a lot of studies on mutual funds and performance and investors and what have you. And one of the big studies they do is every couple of years they take a 20-year time frame, and they study the average compounding rates of returns that the mutual funds get, or the investment funds, and what the investors, and they follow this. They follow the dollar average, purchases and sales to determine how investors do. And I actually have got two examples here because in my seminars I had a slide for 2007 that showed that the stock market had the average large cap equity fund in the United States produced 11%, for the 20-year period up to 2007, and investors earned 4%. I actually just looked up a more current one. They have one for 2010, and again, the average large cap mutual fund produced 9.2%, and the average investor earned 3.25%. Now, that's a 6% difference, okay? And it's interesting how consistent these numbers are. Over 20 years, the average investor manages to capture probably less than half of the return of the average fund. And of course, I always think this is very surprising because we live in a society that's made a religion out of outperformance or beating the market. But the average investor not only is underperforming the market, he's actually underperforming to a large extent his own investments. Now, how does something like that happen where we underperform to such a large degree our own investments? Well, actually, it's quite simple. If we take a mutual fund or any managed money product, these products are designed to be long-term holding periods. And this would be somewhere between 5 and 20 years. But unfortunately, we live in a world of daily pricing, so investment decisions are more motivated by swings in the market. So what ends up happening is that investors will contribute the largest amount to any investment after it has built a superb track record. In other words, they buy the record. Then investors will sharply reduce their investments or sell their investments off entirely when, as it inevitably does, performance starts to lag for a while. So if we look at this pattern of investing, it assures us that most investors buy most heavily at above average prices, which mathematically guarantees below average returns.
Right.
And that's how most investors significantly end up underperforming their own investments. So that brings me to the herd mentality. This is why I sort of watch this and study this, because behavioral economics has taught me that most investors, like other human beings, they're susceptible to herd mentality. The crowd is overjoyed by a rapid rise in the stock market, and of course depressed when it falls. And they end up trading too much. So in doing so, they end up making mistakes, and that's because they're playing a game of follow the leader, jumping into popular investments after they already had a spectacular rise, and bailing out at the first sign of disappointment. So the inevitable results becomes something that is certainly Canadian or North America phenomena in our business, and it's the buy high, sell low investment strategy experience. And of course, nobody is going to achieve their plans using that. So the truth is, the primary determinant of investment success is not the performance of investments at all. It's the behavior of the investor. Long-term investment success is almost totally a function of how one emotionally handles the declines in the equity markets, as opposed to how your portfolio handles them. I tell people it's more important what you do as an investor when the market goes down as opposed to what your portfolio does. So that's one of the reasons why I, as a professional advisor, I try to put my time and energy into understanding what is driving the trend so that I can help my clients form an objective opinion and make the right investment decisions. Wow. And if history has shown us one thing, all the most successful investors have distanced themselves from the mentality of the herd. So my time and energy is spent getting my clients to see the market as they really are so they can generate the type of returns that they require.
Well, Byron, such great information. I'm learning a lot, but we are up against a break. So we'll be right back with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy. We'll be right back.
More Sound Investing with Byron Striloff after this.
Shopping for the lowest mortgage rate?
Looking to refinance? Catch Jared Dreyer in the Mortgage Lab on localwebradio.fm.
Are you struggling with a dental or oral health issue? Dr. Norm Ickert from Ickert Dental Implant Center is committed to improving your quality of life with the very best in modern and advanced dentistry. You can catch Dr. Ickert on the Health Channel for the Healthy Smiles Oral Health Show here on localwebradio.fm and at the Ickert Dental Implant Center in Langley at 866-981-1381. That's 866-981-1381.
Buying or selling a home on the Semiahmoo Peninsula? Catch up on local market conditions on This Week in Real Estate with Lance and Connie Marples from Sutton West Coast Realty on localwebradio.fm. To schedule a face-to-face consultation, you can reach Lance and Connie at 604-538-8888. That's 604-538-8888. And visit them online at www.surreywhiterockhomes.com.
It's now time for more Sound Investing with Byron Striloff.
Welcome back, and I'm here with Byron Striloff, and we're discussing how investor behavior is a critical part of increasing investment returns. Now, Byron, I can see how the emotions could interfere with the investment process. Do you have any suggestions for how people can mitigate the impact emotions can have on their retirement planning?
Well, we could rephrase that immediately. Like, what would the average investor have to do over a 20-year people to earn the 11% that the market owned as opposed to what he earned? And typically, what the average investor would have to do is he would simply have to buy an average mutual fund or investment portfolio, elect the dividend reinvestment, and put it in a drawer. That's all you would have to do. You would put it in a drawer next to your other long-term investments, which are like your mortgage or your life insurance policy. And then if you would have forgotten about it, that probably would have helped. However, he didn't do that. He did something else. In fact, probably a whole lot of other things which have three characteristics in common. And the one of them is that whenever you pull it out and start looking at it, you're always going to do the wrong thing. It's going to be done at the wrong time, and it's going to be done for the wrong reasons. So if I give an example, and I was just thinking about this the other day, and I'm going to use the example of Templeton Growth Fund. I'm not making that as a recommendation. I just use that as an example because it's a household name that most people are familiar with, and it's been around for a long time. In fact, Templeton Growth Fund has been around from 1954, and since its inception up till this year, Templeton Growth Fund has actually averaged 12%. 12% compounding growth over all these years. And mind you, there certainly have been a lot of years there where, it would have been hard sometimes to hold that investment, but it just proves the point that if you make a good investment and hold on to it, okay, that's what the market is capable of returning. So some of the things people want to avoid, to avoid inappropriate behavior, is one thing we don't want to do is only buy funds with the hottest recent performance. Okay, that's how our industry seems to be organized, and we've got the star ratings for all these investments, and of course everybody wants to buy a 5-star investment. And a comment on that is that a portfolio of 5-star funds will either outperform a portfolio of 1-star funds over the next 5 years, or it won't. But I can tell you one thing, after 30 years in the business, there is no way to know in